Hi, and welcome to your weekly macro roundup, where we talk macro and try to make sense of markets that only make sense on days that bond prices go up. I'm your host, Steven Van Metre, and thanks for joining me today on a really exciting day for the macro show because some of you already know the news. I've been invited on Real Vision, and you're all coming with me because you are my family. You made this happen, and I knew you would. I had so much faith, and yes, I did. I said it again. We're going on Real Vision. And when I go, I represent all of us because you are my family. I love all of you. And let me tell you how this happened because there's some other exciting things that some of you also know occurred right at the same time. On Thursday afternoon, my phone rings. The caller ID says, Brent Johnson. And I thought, what are the odds? And sure enough, it was the legendary Brent Johnson of Santiago Capital calling me. And at first I thought it was a joke because he said, hi, Steve, I'd like to invite you. Of course, I knew who he was. I mean, this guy's a celebrity in the macro space. I knew who he was. And he said, Steve, I want to invite you to an interview with me on Real Vision. And I said, I said, no way. I didn't say no. I just thought it was a joke. I thought someone put him up to this. Because what many of you don't know, years and years ago, and I think it's this cool story, I was kind of new and wanting to understand more about the markets. And there was this ad on Yahoo Finance or on the main page of Yahoo. This guy by the name of Raoul Pal, who I'd never heard of, and he had this whole thing about the business cycle and macro. And I watched it and I said, I don't know who that guy is, but I want to know everything he knows. And I could not have imagined then, and I don't know when I signed up for it. I was one of their earlier subscribers, that someday I would be invited on their show. And so then Brent went to Twitter because he said, look, man, you need to tweet. And I said, well, I can't do that. It's a compliance issue. And he went on to Twitter and promoted me. He didn't have to do this. And all of a sudden, things went out of control. I sent a text to my partner, who is also the compliance officer of my firm. I said, look, things are getting out of control. This morning I said, you're not going to believe this, but I have, shockingly, now over 2,000 followers, and I only haven't hardly posted at all, thanks to Brent and all of you who have supported me from just the infancy. Remember when the show was just hardly anybody watched, just a couple hundred views. And I thought, wow, that's pretty cool. I mean, if that's all the show ever is. And now, look, if you're here because of Brent, welcome to the family. We'll make more room. We have plenty of chairs. You are welcome here anytime. So now I'm on Twitter. In fact, what's even cooler, for people who don't know the Dr. Purple story, and for my wife who's going to read here and say, why didn't you fix this problem with your sentences? Because Kim, you cannot edit your tweets after you post them. But there's Dr. Purple and his story on Twitter. So yes, things are going crazy over there. And I will start posting content as I get things figured out. Other cool things that happened. I got an email today from Patrick Seresna. Yes, the Patrick Seresna of Macro Voices, but not to go on Macro Voices. I know some of you said, hey, we really like to see you on Macro Voices. And I keep saying, I don't think that's coming anytime soon. I did not know that Patrick had another podcast. I shouldn't be surprised that he did. And I'm trying to work that out since they record on Fridays. So that's coming. So see, big thank you to all of you. I had so much faith. See, we're a family. We're here together in the macro space. I knew you'd come through, and you did. And we're going big places together. So thank you for being here. Now, for those of you who are new, just be forewarned, I don't edit. This is one cut. This is done live. And sometimes I'm not even sure what I'm going to go over or what I'm going to talk about. So it's really exciting. It's really fun for me, and I hope you enjoy the show. Now, I want to talk about where we left off on Wednesday, because for those of you who are part of the show, you've got to think. I challenge you to dig into the data, to think macro and try to understand it. And I want to come back to the banks tightening lending standards. And do you really understand why that leads to lower interest rates and why I'm so excited about it? So let's get deeper into that. And whenever I'm working through a macro problem, I'm trying to understand the positions of the players and how it affects the world. Sometimes I do a role reversal. So instead of being a borrower, let's put myself as a lender. So try doing that. Sometimes if you can't see the picture, turn it around and take the other view. So now let's say that you're at the bank and you're maybe a loan officer and the boss comes in and says, look, we got a ton of money to lend out. And what are they going to tell you? Look, anyone that comes in here, lend them money because there's a lot of liquidity, there's a lot of dollars floating around. And why would banks want to get rid of those dollars? Well, because they're inflationary. And if you can go and shift them into assets and loans before more dollars come in, then you can get that stuff out of there before you lose money due to inflation. And remember, banks get their interest on loans back when? Up front, right? There's a reason for that. So, there's a reason we have these fully amortized loans. The banks are getting their money back first and then relending it out, getting it back and relending it out. So when there's a lot of liquidity, which is a widely misused term today, thanks to the Fed, or there's a lot of dollars floating around there, what do banks want to do? They want to get it lent out, and they want to lend it to, anybody. The standards then go down. They don't care. Get that money out before we lose money on it due to inflation. And during those times when financial conditions are loose, what direction do you think interest rates probably go? Well, they go higher. They need to go up to absorb all of that money. Because there's demand. There's always demand for people to borrow. And that's something I don't think people really appreciate. There's always a demand for people to borrow money because we're in a debt-based economy. There isn't ever enough money. There's never enough money to pay off all the debt. And that's why when you hear in the news right now about this coin shortage. Now, is there actually a coin shortage? Well, I've got some news for you. There's always a coin shortage. There's always a dollar shortage. There's always a paper shortage. There's always a shortage. But when money stops moving around the system, it becomes very apparent that there isn't enough coins. So interest rates go up when financial conditions are loose because everybody's coming to borrow and people aren't worried about paying more interest because they want to buy something before what impacts that asset. Inflation, right? Buy that home now, buy that car now because next year, 2 years, 5 years, 10 years, it's going up in value. You want to buy now. Don't worry about the interest rate, buy now. So what happens when financial conditions are tight? Well, interest rates fall. It's just the opposite. They go down. You say, well, yeah, in case you're wondering, yes, if you're new to the show, I'm big on props. In fact, we'll get to that. I got some new props for you. So anyways, financial conditions, when they tighten, interest rates go down. Because now the boss is coming out and meeting with the lending staff, the loan officers, and instead of saying, look, I've got money coming out of my ears, I only have this much. I've only got a little bit of money, and I need to make sure it all comes back. Because look, when financial conditions are loose and there's inflation, think of it this way. Let's say a bank lends out $100,000 on a home. Now, obviously, there's a down payment factored in there and all that. But let's say they lend out on a home that's worth $100,000. The buyer puts a down payment down, so the loan's not for exactly $100,000. In inflation, when interest rates are high, if someone were to default a few years down the road, is a bank going to whine and cry about it and act like, you shot their dog? Yes, of course, because it's what they do. But in an inflationary environment, see, the bank's been collecting all that upfront interest on that loan prior to the default. And then the default happens, the bank repossesses the house that's now worth more. So they can afford to have people default in higher rates because they can just turn around and sell the house, act like it really was the worst thing in the world that could happen to them. They're completely impoverished by this burden. But the truth is they made money on the first loan, and now they're going to go sell that property and probably get a second loan from the new buyer, not a second in terms of a first and a second mortgage, but a new loan from the next buyer, and they're going to make money again, except the next loan is going to be at a higher value. So in tight financial conditions, when there's a little bit of money rolling around, banks need that money back. And so the boss comes out and tells the loan officers, look, I need you to get out there and lend. You've got quotas. We've got to get this money out. But by the way, your lending standards are really tight now. I need this money back. And what that's telling the loan officers is, look, you need to go out there and call your customers that have high credit scores, strong balance sheets, and positive cash flow. People who, guess what? They don't want to borrow money because they don't need to. So why do interest rates go down? Is to drag those people out of their house and into the branch so they'll finally borrow. And the interest rates continue to go down, 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 and down until those people show up and they start borrowing. And when they start borrowing and feeding that money into the economy, guess what? It kicks the engine and gets the economy going again. So tight financial conditions are very deflationary and lead to lower interest rates. Now that's why I have a chart that's not that great, but it doesn't have a lot of history. It goes back to January 2015. But here you can see the inverse of net percentage of domestic banks tightening standards for government mortgage loans and 30-year fixed rate average. Well, lo and behold, when things get loosed and the blue line goes down, and let me see if we can make this a little bit bigger for you. I know that's an issue. When the blue line, in this case, goes up, which is inverted, which normally means it goes down, interest rates go up. They follow it higher. And then when lending standards go down, that's because interest rates are going down. So there you can see the relationship and how the two work together. So hopefully, that kind of helps you solidify why I really like the fact that lending standards are tightening. And I don't think they're going to loosen this coming quarter. In fact, the data says they're not. Why? Because the banks aren't lending. I mean, we look at the lending data every week. On Friday, the H.8 is critical. Now I do have before we continue on with the regular part of the Friday show, we're digging into the data. I did not have a chance to read the comments from Wednesday's episode, and I apologize. I do intend to get to them, but my wife does read them, and she mentioned there's quite a few posts about you being the bond king. Some of them were very excited about that and agreed you were the bond king, and some of them were kind of questioning the fact that, well, maybe Jeff Gundlach is the real bond king. Look, let's just put this whole notion to rest about who is the real king, because what do real kings have? Do you know? They have crowns, and that is right. I am the bond king, and it says so right there on my crown. Oops. Well, I'm not very good at this. Bond. Wait. There it is. Bond king. I am the bond king because I have the crown. So Jeff Gundlach, in the highly remote odds that you'll ever listen to this or know who I am, you're one up, buddy. I got the crown. You got to come take it from me. I am the bond king, and that is the way things are. Let's go to the economic data. There's a couple things that I want to quickly look at, and let's see if we can. Oh, good. This is a little bit bigger. The ISM services, I'm not too concerned about. I think we've been over how the ISM works, and we'll pick that up in the future. Redbook weekly retail sales. Here again, look at this on a year-over-year basis. This is telling you, and even though it's brick and mortar, and I know that online sales are commanding most of the attention, but look, when you see brick and mortar retail sales week after week after week in a deeper contraction than they were in the great financial crisis, do you think these stores stay open? Do you think they're going to hire a lot of people? No. And this is a big concern to me that says there's more pain coming in the economy. Let's continue on. Mortgages. Here we see the second week in contraction. Look, mortgage applications need to be rising week after week after week after week. And we'll look at that. It's not a pretty picture. There's a reason interest rates are falling and why banks are buying so many bonds. If you want to see there's some evidence of a market bottom, and I didn't have a chance to pull the Fred data on this, but here you can see exports and imports. I think these are as of July. Yep, so this should be July's data, at least as far as I can tell. Increase. So this would be the potential first indication the economy bottom. Doesn't mean it has. It just means in our economy, you need to see imports and exports increasing to substantiate an expansion. And when they're decreasing, then there's a contraction. So we saw the first blip higher. Maybe this is the beginning of a trend, maybe not. We'll see as things go. I have a hunch that this party is not over at all. Let's see. Crude inventories had a big draw. Obviously, as most of you know, I am by far not the most expert on crude. I am curious, though, because I do know there's still a massive oversupply. If this starts to slow down with school season starting out and a lot of schools not having classes in the classroom, very interested in that. And then Thursday, Challenger job cuts. What are these? These are large employers announcing cuts that are coming. And so you see 262,000 jobs, pink slips were put out in July. This is not a positive sign. These are generally going to be higher paying jobs. Someone working in a fast food restaurant doesn't get noticed ahead of time they're losing their job. They just lose their job. Someone who is, say, an engineer or a manager, maybe a mid-level manager somewhere, they're going to get a pink slip and say, hey, look, your job's ending in 6 weeks or something, or whatever. They are granted some more time, and those jobs are announced, or those job cuts are announced ahead of time. How about initial jobless claims? The market seemed pretty happy. The only just under 1.2 million people filed new claims last week. The real story comes into the continuing claims, which did drop from 16.95 to 16.11 million. But there's something missing out of that number, and it's the PUA claims, which is a pandemic unemployment assistance. Those numbers actually, believe it or not, went up from like 30.2 million to 31.8. I don't remember last week's for sure because I didn't have it, but it's like 31.8 million Americans are on some form of government assistance. How do you have a recovery like that? You don't. So moving on to today, did I have any care for the non-farm payroll report? No, because I can't even tell if it's real or not. But interestingly enough, average hourly earnings did tick up from last month, so that was kind of nice after a pretty big drop the month before. Not enough to offset the prior month, but nevertheless, it did move up. Average hourly earnings slowed to 4.8%. So those who are working are making more than they did last year, but they're also working fewer hours now. So that is not a positive sign that there's going to be a recovery. So I'm curious to see how this all plays out. Now let's move into the H.8 data, because in a debt-based economy, credit is really critical. And when you're the bond king and you're really, long duration, long treasuries, because that's your part of your broad thesis, then you want to see credit contracting, because the more credit contracts or stagnates, the more likely interest rates are going down, and the more likely that is true. So let's go and take a look at the H.8 data. I'm almost having trouble taking myself seriously today after I put the crown on, but nevertheless, we'll hold it together for you. So let's take a look at securities and bank credit. They went up 15 billion over last week, largely driven by mortgage-backed securities, where we see looks like 12 billion there, and treasuries about a 7 billion increase. Treasuries have been floating around this 1.13 to 1.14 trillion. But banks have been steadily adding mortgage-backed securities. And what's interesting about that is when you have the Fed buying mortgage-backed and banks buying mortgage-backed, they are buying 30-year mortgage bonds. Well, guess what that means when they take the supply out of the market? It means interest rates go down. Banks want rates to go down. We talked about that. I don't know, was that Wednesday's episode? I think so. Yeah, I think it was Wednesday. So a lot's gone on between yesterday afternoon and today. So forgive me. Looking at loans and leases and bank credit, big drop here. Looks like just short of 30 billion, so around 27 billion or so there. Let's dig deeper. Commercial and industrial loans down, looks like 17 billion. That's pretty substantial. How about real estate loans? They dropped 7 billion. Not good. At least, and that was mostly residential real estate. That's not good. How about commercial real estate? Now, why anyone would want, if I was a bank, I would not really want to be lending for commercial real estate. Look, the risks right now seem about as high as I could ever think they've been. So I would probably not be interested, but that was flat. Let's continue on. How about maybe consumers rebounded? No, they didn't. They dropped 2 billion. And we see that came out of credit cards. So again, consumers not really spending, automobile loans flat, other consumer loans flat. So nothing going on there, indicating that things are not good for the consumer or the economy. This is not what we want to see. When people talk about reflation, there's no reflation in that data at all. So let's go to the money supply. I meant to have a Fred chart for you. I want to dig into that. And as I mentioned, we are quote unquote live. So from time to time, I'm not ready for things I intended to be ready for. So the money supply, the growth rate is peaking, starting to roll over. Should this be a shock? No. Why? Because why did the money supply grow? And don't tell me it was quantitative easing because the Fed has zero control of the M2. It was due to government transfers. And remember, I've been talking about that I believe we should see the M2 start to come back down as government transfers stopped. And we don't really see it in the 12-month. We don't really see it in the 6-month. But look at the 3-month rate of change. It is just nosediving. It's 3.9% relative to 22% from a year on from this time last year. This is headed sharply lower. And even though we're not going to see probably anytime soon the 12-month rate of change fall below 3.7, you're seeing the 3-month rate of change headed toward below 3.7, suggesting that, again, we're coming back into recessionary territory. And when we go and dig into the M2, so here's the M2. You go, and if you're wondering where we're getting these charts, they're all publicly available. Just go to the Fred database, type in M2, or go to your favorite search engine, type in Fred. Now, for me, it knows what I'm looking for. You might wonder who Fred M2 is, but it'll figure it out if you search it up. But just type in Fred M2 money stock or M2 money supply, and it'll get there. And if we go to the H.6, which is digging into the M2, what we see is money flowed into institutional money funds over last week. So people sold some stocks off. Somebody was selling stocks or risk assets to put money in cash. But look at savings deposits. So in order to validate my view that we should see money coming out of savings, and why would we do that? Because if I'm on unemployment right now and that $600 extra that I was getting is gone, and I still have bills to pay. So now instead of making more than I made before, now I'm making less than I made before. I've got to still pay my bills. And then starting, I believe, as soon as next month, we should start to see loans coming out of forbearance. And I'm not suggesting everyone's going to get that lump sum payment, but due for the 6 months, because some loans are going to be kicked that 6 months back to the end. Nevertheless, there's a payment that's going to have to be made. So let's just pretend that every loan that was in forbearance is having all those missed payments kicked to the end of the loan. There's still monthly payments due starting next month, and people's incomes are less. So how are they going to get or make up for that shortfall? It's got to come out of savings, out of the M2. Makes perfect sense, right? So let's look and see if my thesis on that is correct. And we look at savings deposits decreased right there. So yes, that is valid. How about other checkable deposits at commercial banks? Yes, that is dropping down. It makes perfect sense to me of why we should see a decline in the M2. And with all the people who think the M2 is inflationary, they're about to find out that not only did they not get the inflation they were looking for, it's going to be deflationary. All right, where are we at? No change in the monetary base. This is updated every 2 weeks. And so no real change in the money multiplier. It's flat at 3.97. Now remember, the money multiplier does not guarantee inflation when it rises. It suggests inflation is rising because the money multiplier is the M2 divided by the monetary base. And when the M2 is normally rising faster than the monetary base, what does it imply? It implies people are saving money. And when you save money, you have future spending. And that's why it's viewed as inflationary. So let's say I'm saving money for a new car and I'm putting money away every month. It's going to go into the M2. And when it comes out to buy that car, it becomes inflationary. So the money multiplier, where you see the M2 outpacing it, you see, wow, the M2 is really rising. Must be inflation. Well, depends on where that money is going to come out and go to. It's going to living expenses and to debt. Not going to see inflation there at all. All right, let's go on to real estate loan growth. And again, you got to look at this data and ask yourself, how can we have higher interest rates when interest rates are at record low levels? The growth rate from a year ago is flatlining and trending lower. I mean, it's starting to move lower, but it's at a weak level. It's below 4%, and it needs to get over 4%. The 6-month rate of change is at 1.14 and falling, and the 3-month rate of change has bounced off of zero over the past several weeks. And you got to understand, this data does get revised every week, so week to week it can adjust, and I have to adapt to that a little bit. So the 3-month rate of change is rising, but don't get excited. It's effectively at zero. How about commercial industrial loan growth? We go, wow, but it's at 19% from a year ago. But on a rolling 3-month basis, it's at negative 8%. This is exactly what happens during recessions, and you get a contraction of commercial industrial lending. This is another reason. So you look at this, say, well, there's no lending growth in real estate loans. There's contraction in commercial industrial, and you wonder why banks need lower interest rates, because they need people to come and borrow. We're in a debt-based economy. Remember, as the debt gets bigger, the economy grows. And when the debt contracts, well, so does the economy. How about loans and leases and bank credit? All commercial banks, this is represented about a third of all debt in the marketplace. Growth rate is down to 7.1%. 6-month rate of change, actually this is falling. I don't know why I needed to update that. And the 3-month rate of change is falling. So this thing is headed lower, also consistent with recessions. How about the consumer? Well, credit card growth rate, we've seen consumers paying down their debt. And actually, it should not say flat. It should be down to 8.37%. Clearly, the chart is right and my typing is wrong because I forgot to update that. This is not indicating any rebound in consumer spending or consumer credit growth. All right, let's go back to the Fed charts, because I want to talk about the speed of money. And I think this is something a lot of people get wrong. And they don't understand that velocity of money, or how fast it changes hands, really matters. And it's a really key piece of data that tells us long-term inflation expectations. So when the velocity of M2 is falling, you should expect lower interest rates. And when you see the velocity of M2 is rising, you should expect to see interest rates rise. It's pretty straightforward. Now, everybody thinks the velocity of money is going to shoot higher. As you can probably guess, I don't. Now, do I think it can and probably will rebound? Yes. Do I think it's going to have a big move higher? No, because I don't believe people really grasp why the money multiplier is low and is not going to come up much. If it does, and it may not. So let's look at the money, or not the money multiplier, the velocity of M2. And here you can see, going back all the way to 1959, the full data that Fred's got in the database here. And no, it's not Fred's database. It's no, that was a bad joke. Anyways, as of the second quarter, you see this big crash in the velocity of money, which makes sense because businesses were shut down, money couldn't move. We know there's a coin shortage. Well, there was one anyways. It's now just actually obvious that we don't have enough currency, and there you see it represented in the velocity of money. Now, a lot of people think jobs are coming back. Well, the velocity of money has a nice relationship with the labor force participation rate, which bounced off its lows, and it's rolling over. And I've been saying, jobs are not coming back. A lot of jobs will not be back due to the fact that money is moving so slowly. And everyone's, of course, now hoping that the money multiplier rises. But they don't really get it because they don't understand what is driving the speed of money. And it's the problem is the U.S. government's crowding out private industry with too much debt. We have a debt problem. I mean, Fed Chair Powell, up until, of course, the financial crisis, and he did all of this easing, kept saying every time we have a debt problem that Congress needs to solve. They need to deal with it. And now that I'm thinking about Fed Chair Powell, this also reminds me, coming back to the tightening, the bank standards tightening. Think about this. When did Fed Chair Powell unleashed this unprecedented amount of QE? Back in March, right? Early March. And he just flooded the economy with liquidity. In fact, he threw the term around liquidity, money printing. We've heard President Trump, liquidity. We've heard the Trump administration from Kudlow and Mnuchin. Oh, there's just so much liquidity. I mean, you would think that there's so much dollars floating around that I would be sitting on a pile of them in my office here. And when you look at, and I forgot where I was going with this. Oh, lending standards. What do lending standards tell you? If there's all this liquidity, why are lending standards tightening? Why are banks tightening lending standards if there's all this liquidity? Because it's being misused. It's a misused term. The Fed didn't add any liquidity to the economy. They didn't add any dollars. They did a swap in reserves, as we've talked about. So I just want to point out that sometimes you have to see through the smoke. Remember, a lot of government agencies, and I'm not picking on the Trump administration at all, because they're not the first, not the last, that will try to use their position in the government and in the world, as Fed Chair Powell does, to get people to get out there and spend. As they will say things and use words like liquidity, which you don't really understand because nobody does. It means how many dollars are sloshing around the economy, and there aren't. They didn't create any. All they did was borrow a bunch and give it to people. I mean, that's where if you want to look at why the M2 rose, it had nothing to do with the Fed. It had everything to do with borrowing money and giving it to people that were out of work. And then to help those people who are out of work, we said, hey, you don't have to pay on your loans. So yeah, here's a bunch of extra money, and you don't have to make any payments, and people put it in the bank, and all of a sudden, oh, look at all the liquidity the Fed created. The Fed didn't create any of that. So you look at the fact that the federal government is crowding out the private economy, and you can see going back in the 70s, when government debt was relatively low, velocity of money was fairly stable around 2% at 2, and then the velocity rose as, of course, the boomers really started spending money and had kids, and people like your host here were graduating high school in the early the kind of mid 90s, and all of a sudden now government debt, which is in red, starts to slow down the speed of money. And as government debt starts to rise here now, right in the kind of late 90s, early 2000s, it starts to crowd out the private economy. And you can see government debt is rising, velocity of M2 is falling. And the easy way to look at this is to simply invert the government debt against the velocity of money. And there you go. You can see it's very, very clear that as we borrow more and more and more money, we're not going to have inflation. And that is what I've been trying to tell people, is the government is crowding out the real economy. And look, I understand for humanitarian reasons we need to help people out. I'm not saying that we shouldn't do that. What I'm saying is all this debt is going to have a big cost. Everyone thinks that this debt is going to lead to a resurgence in the economy. The bond king says, no, it's going to lead to worse financial conditions. It's going to lead to lower interest rates. And the government's going to respond by borrowing more money because they think that, hey, if we borrow more money, that'll fix the problem. No, the problem is we borrowed too much money. And I don't know what the way out is, but without making major changes to the monetary system and the laws governing our country, the solution is austerity, meaning we have to pay that money back and go through an extended period of pain. And we're not done yet. We're not through the recession yet. We're only going to end up borrowing more and more and more money. So keep that in mind. Coming to today's non-farm payroll report, which I looked at and really didn't care too much about, I had been predicting that non-farm payrolls were going to tank, because if you look at when the Fed lowers rates, so here you can see 3-month Treasury bills falling, it usually leads non-farm payrolls. It's an indication that financial conditions are tight. So if we zoom in a bit, you can see the Treasury yields they bounced and are rolling over. Non-farm payrolls have gone up 2 months in a row, but based on some history, those non-farm payrolls are going to flip. Because here you can see as soon as yields crashed, look at that. Now, was this an exaggerated move due to the virus and the pandemic? Sure. But it's not a fake move at all. All right, I want to take a look. I know the Friday video I said was going to go a little longer. I want to look at a few charts. I want to look at bonds because, hey, I am the bond king. And when you're the bond king, you have to look at bonds. So what happened today, we saw 10-year Treasury bills come back up to this trend line that they almost breaking out. My thesis is so close to playing out. I mean, we're within maybe a week and a half or 2 weeks, close to that. I still think, I mean, definitely within 60 days, but I think we're very close to starting to see this move down. And sellers came in also on the 30-year and just slammed yields higher. They had to. They had no choice. They have to defend. Now, people say, no, buyers need to buy. No, when you're about to break through the top of this pattern, no, it's sellers that need to defend. So I drew this dotted Cayenne line up here. So when we zoom in, you can see that this dotted Cayenne line goes all the way back to where we were not quite 90 days ago, right at the top. I mean, this is it. This is kind of it. We keep knocking on the door higher, and there's not much more to go before this thing gets out of control. And the sellers are so deep in their short positions, they have to defend. And what happened today? Well, in overnight trading, they popped up. Bond prices went up. Sellers came in and just slammed all the way down into this lower consolidation zone. Remember from our video the other day, we have this three purple lines as a consolidation loan, and these three Cayenne lines as a consolidation loan or zone. Wow. And it slammed it all the way down to the midpoint of this one. Buyer stepped in, and then, in late afternoon trading, they came in and hammered this thing down, but it found support here. The Fed's coming back on Monday with more QE. This party is not over, but I just want you to see this is how close it is from liftoff. I mean, I thought maybe we'd get in here, but it's super, super close. Another thing that's worth looking at is the dollar. And what we see here is now a potential double bottom. It came in and bottomed again in overnight trading, and is now back up into this long trending supply zone. And if we zoom out, that's too far. That's still too far. What you can see is it's right back in this long established supply zone, DXY right kind of at the 93 to 94 level. If this thing finds support in here, and I suspect it will, because remember, the dollar eventually is going to follow bond prices higher. Well, the risk we have is that the dollar breaks over 100 and potentially breaks through 103, because the big question I have for the dollar, and perhaps I don't know when Brent and I will have our interview. I'm really looking forward to it because I actually brushed up on his dollar milkshake theory, and I didn't realize how close we are in our views. He obviously was more right than me about a few things, and we'll see how this plays out. But this is a consolidation pattern. It's a sideways, almost a rectangle. Draw a rectangle. This is a consolidation pattern. Usually consolidation patterns go higher. So what if the dollar breaks through 103? The Fed is going to have to do so much quantitative easing. It's going to be a dollar rising. So think about it. You've got we know that yields are about to break down. You can just look at the chart and see that. We know banks are tightening financial standards. All the next thing, you get the trifecta of tightening when the dollar goes, what I'm going to say is supernova. I'm actually concerned, and I'm not just saying this, for positioning sake. I'm just saying just general for the U.S. economy, the global economy. If this is, in this chart, a consolidation pattern going higher over 103, it's going to make the great financial crisis look like, a joke. I mean, it's just going to be a destructive wrecking ball in the economy. And I still believe that that's super bullish for bonds. And when we go and look at, because I think inflation is headed much lower and real yields are headed lower because the dollar, and the last chart I want to show you, and I can't remember if we looked at this or not, and I like looking at it. So we're going to look at it again. The consumer price index against the trade weighted dollar. And when the dollar goes up, consumer prices go down. See, everybody thinks the CPI is going up. They think the dollar is going to zero. Guys, the story I keep hearing over and over, dollar is going to zero, dollar is going to zero. No, the dollar's going higher because it's going to follow bond prices up. It's going to validate. It's going to give us that trifecta in tightening. It's going to do everything it did in the great financial crisis, just at a much bigger scale. We've got two. Effectively, we've got two. Yields are saying, hey, things are really tight, and we're about to make them super tight. Banks are at the same or near same level, depending on which category you look at, of tight financial conditions and lending standards. And now the last one you need is a dollar. It's the last one. When the dollar starts to move, this whole thing gets unwound. the consumer prices crash, that is part of my view that gold gets an adjustment lower. That's how real yields start to rise. You get the big bull market, the final big bull market in bond, maybe not the final one ever, but you get a really, really nice one, all because of this chart right here in the dollar. And the question is this a double bottom or maybe a double and a half if you count that overnight move? Does the dollar get through this bottom supply zone and start squeezing all these shorts out? I think it does. I really think it does. So anyways, I want to again thank everyone for being here today. Thank all of our new guests. Of course, give them a warm welcome. I will get to the comments this weekend. I got that on my list to do. So again, thank you from me, the Bond King, and yes, my wife is the prop master, and she says you got to give this video a thumbs up and be sure to subscribe because hey, the show is free and it's fun, and I love having you here. And with that, I'll see you on Monday. The content of this video is provided as education information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that I do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.